Okay, good morning everyone. We are starting the webinar now. So today we initiated coverage on Mapletree Industrial Trust. This is the disclaimer, please read it. So the title of our initiation report is Low Gearing Still Has Firepower for More Bank. We are initiating with accumulate rating, target price of 170. Last close on Friday was 161. There's a 52-week range, 135 to 164. The market cap for Mapletree Industrial Trust is about 2.9 billion. This is a one-year chart of the price for Mapletree Industrial Trust. Investment thesis. So it's a pure play on Singapore's industrial real estate sector. In the next few slides, I'll go through these 8 points in more detail. Okay, firstly, Singapore's economy is forecasted to grow, but at a slower rate. This chart here, the blue line is the GDP year-on-year growth. The axis is on the left side. The orange line is the industrial production index year-on-year growth, and the axis is on the right side. So first thing, the 20-year average growth for GDP has been 5.3%, which is represented by this gray line. And a 5-year average growth is 3.5%, which is lower than the 20-year average. Currently, MPI, which is Ministry of Trade and Industry, forecasts for 2016 GDP growth of between 1 to 3%. So this 1 to 3% you can see is even lower than the 5-year average growth rate and the 20-year average growth rate. From their survey of private sector economists, the private sector economists have lowered their expectations for growth to 1.9%. Previously, a quarter ago, their expectations was 2.2%. And for the consensus that's on the Bloomberg 2015, oh, this is a typo. 2016 is 1.9 and 2017 is 2.2. Okay, this chart is showing the percentage contribution from the different sectors to GDP across the last 4 years. So for manufacturing sector, which is the orange segment here, you can see that for 2012 it was 19.8%, and it was contributing a smaller percentage across the years until 2015. Last year, it contributed 17.8% to GDP. So here, first bullet point, in 2015, the manufacturing sector contracted 5.2% to 69.6 billion, and it accounted for 17.8% of the economy. This 17.8 is lower than the previous 3-year average of 19.4. So MTI is expecting a weak outlook for manufacturing sector due to weak external demand and negative impact from lower oil prices. Also, we believe that industrial production index will be between -3 to 1% in 2016, and private sector economies are forecasting negative 2.7 contraction for this year for the industrial production index. So this is coming from the demand side of things for manufacturing. Now we'll look at supply. So supply, this is nothing new. We've been saying this several quarters really about the oversupply of industrial space. So this is as of The end of 2015 JTC data, they're expecting 2.9 million square meters of space to come on stream in 2016 and another 1.6 million to come on stream in 2017. This is equivalent to 6% and 3% respectively of current available stock. The new supply is significantly higher than the average annual supply of 1.7 million square meters in the past, and the historical average demand was 1.2 million. So with new supply exceeding new demand, there should be downward pressure on occupancy and rent. So from the IPO prospectus of Mapletree Industrial Trust, one of the points made was that the real estate sector is relatively resilient compared to the commercial real estate sector during the global financial crisis. So for industrial real estate, the rents fell by 13.4% and occupancy dipped 1.8 percentage points. This in contrast to commercial rents in the central area, which fell by 24.6% and the occupancy dipped 3.3 percentage points, which so it shows that they fared commercial rents, commercial real estate fared worse than industrial real estate during the GFC. Now we move down to the portfolio of Mapletree Industrial. So one key thing is that it has customer stickiness. They are having above average occupancy, good tenant retention rate, and they are having long staying tenants. So here the blue line is showing Mapletree Industrial's portfolio occupancy, while the orange line is showing the JTC's sector-wide occupancy. So you can see that Mapletree Industrial Trust, they have a occupancy of greater than 90% and is also better than the JTC average. Their tenant retention is between 60 to 80% thereabout. What this means is that whenever there's lease renewals, 60 to 80% of their tenants will continue to stay with them and renew their leases. Consequently, 61% of their tenants have leased their property for more than 4 years, bearing in mind that a typical tenure for a lease is only 3 years. So the 61% of tenants would be this blue segment, green segment, and this dark red segment. This starts from 4 to 5 years and goes all the way to more than 10 years. So you can see that they have many tenants who stay for many years and do renew longer than their typical 3-year tenure. Platter factories, the bedrock of the manufacturing sector, means portfolio. So in the IPO prospectus, it was stated that SMEs are the backbone of most economies, creating jobs and generating wealth for a large part of the population. Flatter factories are the #1 choice for SMEs because of its low rent. So for Mapletree Industrial Trust, their exposure to flatter factories, they have about 45% by value as of the most recent quarter, 49% by gross rental income, and 50% of their net property income comes from flatter factories. This is for the first 9 months of the current FY. You can see that their occupancy for flatter factory segment is also higher than their average portfolio. Next is upcoming supply of flatter factories not in direct competition to Mint. So the majority of the new supply of flatter factories are in Tuas, but Mint doesn't have any flatter factories in Tuas. Their factories are mainly centrally located and somewhere off to the east side. So their best performing flatted factories are the centrally located ones in Toa Payoh North, Tanglin Halt, Redhill, and Tiong Bahru. Their occupancies are between 89 to 99.8. So 99.8 is almost 100% occupied. And bear in mind that these are multi-tenanted buildings as well, and not master lease buildings. Their largest cluster is at Kallang Basin. There are 6 clusters of properties there, and the occupancy is also good, 89% to 96%. So the other thing is that they're trying to move up the value chain by growing the high-tech business, high-tech building segment. So the high-tech buildings, this is to cater for demand for higher specific buildings as the domestic manufacturing activities move up the value chain. So typical tenants of high-tech buildings come from precision engineering, medical technology, clean and light manufacturing. So this chart here on the left shows, the blue line shows the percentage by portfolio value of the high-tech building segment. So it's currently at 23% now by portfolio exposure. You can see that they are also growing the gross revenue and net property income for the high-tech building segment. So as of 9 months of first 9 months of the current FY, their exposure to high-tech buildings in terms of gross revenue is 20%, and likewise 20% for NPI. Okay, so that was the top-down view on manufacturing sector and Mapletree Industrial Trust. Now we go into some of the trust specific details. So Mapletree Industrial Trust is an industrial REIT with a Singapore-focused mandate. It is a diversified portfolio of 84 properties. It was listed in October 2010 with an offering price of 93 cents. So their strategy is to provide quality industrial space in Singapore, and the other strategic trust is to grow the high-tech building segment. NLA for the portfolio is 14.8 million square feet and is valued at 3.4 billion as of 30th December 2015. So they will pay quarterly distributions. They are obligated to pay at least 90%, but they have been paying 100% payout since their listing. They had a DRP that was introduced in the third quarter of FY13, and they have just suspended this DRP in the most recent quarter that's ended, third quarter of FY16. The DRP in the past was used to fund the BTS and AEI projects. This just shows the trust structure. Their sponsor is Mapletree Investments Private Limited, and the REIT manager is Mapletree Industrial Trust Management Limited, which is a wholly owned subsidiary of the sponsor, and the trustee is DBS Trustee Limited. So manager fee, their base fee is based on AUM, and performance fee is based on NPI. All these quite standard among the REITs. Distribution, so a bit more detail about their distribution. They had a policy to pay out 100% until the fourth quarter of FY12, and thereafter 90%. However, they actually have been paying out 100% since the listing. Their portfolio is diversified across 5 property types, which are flatted factories, high-tech buildings, business park buildings, stack-up ramp-up buildings, and light industrial buildings. For more details on the characteristics of these 5 types of buildings, please go and refer to the report that we have uploaded inside the Poems platform. Okay, this is a map showing the location of their properties. So the thing that I want to highlight is the location of their flatted factories. as I mentioned earlier, their best performing flatter factories are in the central region, which are these ones, the one at Toa Payoh North, Tanglin Halt, Redhill, and Tiong Bahru. These are the ones that have the highest occupancies in their portfolio. Then the biggest cluster is here, Kallang Basin, which there are 6 properties here. So this pie chart just shows the exposure to each of the property type by portfolio value. The biggest is flatter factories, and the second is HiTech Buildings. So this for 9 months of gross rental income and net property income, same story. Flatter factories is contributing the most, and second is HiTech Buildings. This shows the typical rent for their different type of properties. So flatter factories is here, HiTech Buildings, business parks, and stack up ramp up. So you can see for a flatter factory, the rent is typically about $1.76 per square foot per month. And their units, the smallest size goes for 1,000 square feet, and subsequently 3,000, 5,000, and so forth. So for SME, if it rents 1,000 square feet and pays a rent of $1.76, their rent would come out to be $1,760 per month, which is very affordable, and this is what keeps the occupancy for flatter factories resilient, because it's the first choice of SMEs to go to. This pie chart shows their sector exposure of their tenants. So they say that no single trade sector accounts for more than 16% of their portfolio GRI. So what they're referring to is the outer ring here, where none of it is none of the segments in the outer ring is more accounts for more than 16%. This is the biggest segment here, which is just under 16%. But if you group it according to a more cost grouping, then for manufacturing it would take up 39%. Infocom, which is this one, is 13%. Financial and business services 12%. Wholesale and retail trade here is at 25%, and others is 12%. The other thing about the portfolio is that GRI is weighted towards multi-tenanted buildings. Most of their buildings are multi-tenanted. Consequently, 94.6% of GRI come from multi-tenanted buildings, and the remaining 5.4 comes from single-user assets. This is as of FY15. This chart shows their portfolio occupancy. The dark blue line here is the portfolio average, while the other lines are showing the occupancy for the other segments. Okay. For organic growth, they have inbuilt rental escalations, about 2% per annum. They also have a track record of delivering build-to-suit HiTech Buildings projects. One is the KNS Global Corporate Headquarters, and the other is Equinix Data Center, which TOP in October 2013 and January 2015 respectively. So they also have an ongoing BTS project, which is the Hewlett-Packard HiTech Building. This is expected to be completed in 2 phases, second half of 2016 and the first half of 2017. One thing to note is that there will be some negative impact from this at the start, because they're giving 6 months rent-free incentives. So for the first 6 months, the REIT will have to incur the associated expenses, but they will not be recognizing any revenue. So we are estimating that this negative impact will be in the second half of the next financial year, so FY17. The other thing is that they have an ongoing asset enhancement initiative at Kallang Basin 4 cluster, expected to be completed in the fourth quarter of FY18. What's going on there is that they are developing a 13-story high-tech building. So this on the left shows the Hewlett-Packard BTS, which is in the Telok Blangah cluster, and this on the right is the Kallang Basin 4 cluster AEI. So this picture here shows the progress of the work, and this is a artistic impression of what the buildings are supposed to look like when they're completed. Here, this is a picture of the car park where they're going to convert it into a high-tech building, and this picture here shows what it's supposed to look like when it's completed. So for inorganic growth, they can do third-party acquisitions. They did one light industrial building in May 2014. They also have a ROFR from the sponsor. So the sponsor also has this property that in Tai Seng. Is under construction and is expected to be completed in first half of 2016. So this building also probably will take some time for the tenancy to stabilize, and then it can be ready for injection in the portfolio. So this shouldn't be coming anytime soon. Okay, so next this slide, I'll talk a bit about their capital management. So firstly, they have got a really low gearing and a comfortable debt headroom. So their gearing now is 29.3%, and this is the second lowest gearing among all the industrial REITs. So for sector, the highest gearing among the industrial REITs, the highest gearing is actually 42%, 41.7%. The lowest is 29.2. It's almost negligible difference from 29.3, and the average is 35.5% gearing at the moment for industrial REITs. So for Mint, their estimated debt headroom, they have it at 580 if you assume a 40% gearing. So this gives them the potential to grow their portfolio by 17% from the existing 3.4 billion worth of investment properties. They recently refinanced 60 million of their debt, and this resulted in their weighted average debt maturity to be pushed to 4.2 years, which were previously at 3.6 years. They also hedged the interest rate exposure, 85.6% hedge, but they will be having about 420 million worth of their floating rate borrowings expiring in the next FY. So the manager is guided that replacing these expiring hedges will be more costly compared to current. Okay, this one I've mentioned before earlier. DRP was introduced and has been suspended in the after the most recent distribution. This is their debt maturity profile. So this is the 60 million I was talking about, which has been refinanced and it's been pushed to here. So for the next FY, they have about 64.6 million to refinance. Okay, so compared to the other S-REITs, they actually have a relatively short WALE of 2.9 years by GRI. This is due to their large proportion of multi-tenanted buildings, of flatter factories, business park buildings, and stack-up ramp-up buildings. If you look at this is their lease expiry profile, and it's actually quite evenly staggered across the years. So if you compare where they stand, 2.9 years by GRI, the sector average is 3.7 years. Sector longest is 4.8 years by GRI and 8.7 years by NLA. This 8.7 years comes from Capital DC REIT. So the investment merits for Mint, firstly, this firepower to grow the portfolio. So as I've explained earlier, their gearing is low. They have a debt headroom of 580 million, and this has the potential for them to grow the portfolio by 17%. They have a diversified portfolio of properties across 5 segments. So this is a way to gain exposure to the manufacturing sector through the derived demand for industrial real estate. So manufacturing sector is the second largest contributor to GDP. Of course, manufacturing sector is looking weak at the moment, but as I explained about their portfolio for Mint, they have a large proportion which is from flatted factories, and the flatted factories segment is a stable segment. This is because it's a low cost space that is always in demand by SMEs. So even if one SME does not renew, they usually are able to find replacement SMEs who want to move into their flatted factory properties. The other area that they are trying to grow is the high-tech buildings segment. So this is in line with the economy moving towards value-added manufacturing. And finally, they have an attractive dividend yield of about 6.9%. This is a forward dividend of FY17. These are the risk factors. They are quite standard risk factors. Refinancing risk, interest rate risk, financial risk, occupancy risk, tenant concentration risk, operating risk, regulatory risk, and execution risk. So do take some time to read through this list as well. Our valuation is based on DDM, so we have a target of 170 based on DDM valuation. Okay, downside risk to our valuation. So first of all, Kallang Basin 4 cluster is a speculative AEI. It was done without pre-committed tenants. So there's no way to know what's the demand for this property going to be like. And if we compare with their previous experience where they also did a speculative AEI at Toa Payoh, one of the clusters in Toa Payoh, what happened after the AEI was that they took up to a year to fill up the property. So if there's anything to go by, I think we should just assume the same thing, that the ramp-up period for this Kallang Basin 4 cluster will also take up to a year. And if it does take longer, then that will be a downside risk as well. So we also identify that risk of valuation is that worse than expected rental reversions and non-renewals. So while the manager has guided his expectations for flattish rental reversions going forward already, and so if they were to have strong negative reversions and rampant non-renewals, then this would have an adverse effect on the portfolio as well. Here we do a peer comparison, so we see that they have 6 other S-REIT peers. We have excluded Capital DC, Mapletree Logistics, and Cash Logistics from the peer comparison because of the type of properties they hold. So what we see from this table is that the larger capitalized REITs, which are in terms of billions, right, Mapletree Industrial and Ascenders, they trade at a premium to book. And now this is a historical comparison for Mint valuation. So what we see is that Mint has never traded at a discount to its book value. The lowest it's ever traded is 1.08 times price to NAV, and it's currently about its average price to book multiple now. In conclusion, we're saying that Mint has a low gearing, and this would, is its firepower to do more acquisitions and grow the portfolio. So we have an accumulate rating, target price 170, and last close on last Friday was $1.61. Okay, so we've come to the end of the webinar. We'll pause for a moment to assemble the queue for the questions. Yeah, there's a question. Why advocate Mint when she faces strong challenges of inability for positive rental reversions due to excess supply industrial spaces in weakened Singapore economy, increasing interest rate environment, and low 5% price return based on fair price of 170 from 161. Okay, firstly, it has, as I've explained, is the low gearing. The low gearing 29% only, and if they were to gear up, they can increase the portfolio by 17%. That's where they have the ability to grow the portfolio without um, the ability to grow the portfolio compared to other of the REITs. 5% price return, that is capital gains, but we're forecasting 6.9% dividend yield. So if you want to add that, then that would be 11.9% return. Yeah, so the key thing is it's low gearing that they can uh, grow the portfolio. Also, if you look at the relative price chart that we have shown on the first page of the report, Mint has actually outperformed the STI by a wide margin in the last 12 months as well. This is testament to its stability. Uh, I've already explained the portfolio is half of it is flatter factories, which is stable, is always in demand by SMEs because it's the cheapest possible solution for them. Okay, we don't see any other further questions. Okay, okay, one question just came in. Okay, so there's this question, what will be the catalyst to lift Singapore's manufacturing sector? So let me go back to one of the earlier slides. Okay, from here, so the thing is that here, this slide, so currently the weak outlook, right, is due to weak external demand and negative impact from oil prices. So the catalyst will be a reversal of these two factors, increase in external demand and oil prices, which becoming at a more sustainable and sane level. Okay, it seems like there are no further questions, so we shall end the webinar here. Do tune in again next week for the next webinar. Thanks. Bye.